Welcome back to Morning Trade Live. Time to go inside out on Broadcom ahead of its earnings. Joining us is Matt Tuttle, CEO and CIO, Tuttle Capital Management. Thanks so much for joining us, Matt. Good morning to you. What are your expectations for this report card?
Yeah, so I think this is an extremely important report. Yeah, to us, there are two must-owns when it comes to semiconductor AI names. It's Nvidia and it's Broadcom. So what I worry about, though, in this report is Broadcom's valuations, kind of the headwinds from the way that the markets have acted around Nvidia's earnings, what happened with Marvell, which is not a must-own in our opinion, but it's still out there. So I do worry that they've kind of got expectations to the point where they almost have to have a cure for cancer to do really well here. If the market is disappointed, I would definitely be buying a dip if that happens. Maybe a little bit of wishful thinking on my part, because I would like to buy a dip on this name.
Okay, I mean, yes, it is a certainly difficult week, you could say, also to be reporting earnings with so much laser focus on the macro side of the equation. And no doubt, the markets are going to be very driven by what we hear from some of the economic updates. But as you say, you're not the first person who's sort of said it's just all about Nvidia and Broadcom, because, I mean, you really do need the infrastructure and the network, and that's where Broadcom sort of steps in here. I'm just wondering, on the growth side, as far as numbers are concerned, what you're expecting and, what that will be driven by largely.
Yeah, I mean, I'm expecting a blowout quarter. I mean, you've seen the Magnificent Seven talk about AI spending. A lot of that money is going to go to Broadcom. So I'm expecting a blowout. The things I'm going to be focused on more than anything would be, all right, I mean, we know you're going to get a lot of money from the whole hyperscaler build out. I want to hear about margins. Are you going to be able to have margins continue to improve, or margins going to shrink? I also want to hear about VMware. I think that's something that makes this name really interesting, and not just an AI name, because I think, a lot of what we've seen in this market and in names like this is people assuming that this AI spend is going to continue to grow. And at some point, and I've written about this in our newsletter a couple of times over the past few days, at some point you could have a kind of a where's the beef type of moment on AI spend, where somebody says, well, wait a second, when are we going to monetize this? And I really like the combination of what Broadcom has with VMware. So that's something else I'll pay attention to.
Okay, I'm just seeing as far as some of the analyst calls ahead of this earnings report. You've got the folks over at Evercore ISI raising the price target to 342. We're at 305 right now. I mean, they see a lot of positives. They're also talking about the TPU product cycle at Google, high demand and high-speed data center connectivity and networking chips. Is that some of the stuff that you're going to be looking at as well, as far as what this company has to say later today?
Oh, yeah. I mean, definitely, we've heard from the Mag 7 names. Now I want to hear from Broadcom. So I want to hear about Google. I want to hear about Meta. We want to hear about all of that. And again, I mean, I expect a blowout. I don't know that it's enough with the heightened expectations right now.
Yeah, I mean, we've seen even with some of these big names that it's still even not enough if you clear the bar as far as the numbers are concerned. It's really about the guidance, the forecast, how you're thinking about the future. I'm just wondering, in that case, given the names that we've heard from, and particularly the reaction as far as the market is concerned off the back of Nvidia's report cards, what your expectations are for a company like Broadcom, given that the market does seem to think that the semiconductor and the AI narrative remains very much intact. But, there are still some of these questions about, monetization and show me proof of all that spend. Is that a concern?
Oh, I mean, it's definitely a concern. And as I said, I think we've covered that twice in our newsletter, because it's such a concern just from the standpoint of that, I mean, that's what's holding this market up. If people stop and wonder, hey, when are we going to monetize this? How are we going to make money? How can we justify all this spend? A company like Broadcom is going to take a hit. And, valuations don't matter until they do. You could argue that, who cares about the valuation now if we're going to get this AI spend out into infinity, but at some point valuations are going to matter. I've heard Broadcom referred to as, Nvidia's poor stepchild, but yeah, I don't think based on a valuation metric that they're there right now.
Yeah, I think it's been referred to the Oppenheimer analysts, Nvidia's number 2. But, it certainly is important to look at through that lens. But we're going to have to wrap it up there. Matt, thank you so much for your time and your analysis and insights today. Matt Tuttle, Tuttle Capital Management. Appreciate your time. Let's trade it now with Tom White, host of Fast Market. And let's start with your neutral to bullish approach ahead of these earnings. Tom, good morning.
Yeah, good morning, Sam. This strategy kind of sets up with what Matt was saying. He'd like to buy a dip on this one. And I think a lot of people might look that way. The stock's just pulled back from those all-time highs, about $317, but it still had a great run, right? Still up over 30% so far this year. Option market pricing in about a plus or minus 6% move in the shares, about nearly $18 either way. So I set this up with that in mind. Went out to the September 12th weekly cycle here using the option market. So not a pure earnings play. I've got 8 days until expiration. So if we do get a sell-off like we saw in some other tech names and then they rebound, this would work out. And this is a twofold type of position also. So I looked at a cash secured put going out to the September 12th weekly options that expire in 8 days. We're going to sell an out of the money 290 strike put. You're going to collect a credit on this of about $5. It's probably trading closer to $6 right now. Stock has pulled back from those session highs. But on this type of strategy, you look at it as implied volatility levels are elevated. I either want to collect a hefty option premium, which in this case, if you collect $5, you can profit $500, right? And it takes your break even down to 285 to the downside. That's going to be about 6.5% below the current share price in here. Now, I mentioned that it's twofold, right? You either want to sell this put with the expectations it's going to remain above 285, that break even. You can profit on that. Just keep the credit you collect. Or if it does fall below 290 over the next 8 days, you get assigned on it, you're willing to buy the shares at 285 at that 6.5% discount to where the shares are currently trading. Now, you've got a lot of risk if the stock continues to fall, but this is a way to set up where, hey, even if you don't get that pullback where you can buy the shares cheaper, which you want, as Matt mentioned, you still get to profit from the trade if the stock goes higher, remains where it is, or even goes lower, but just remains above that 285 break-even level.
Okay, and take us through a more bullish example trade for this one.
Yeah, this one I'm going to set up just using that vol dispersion that is taking place because the near-term implied volatility level is really elevated because of that earnings event risk tonight after the close. So short-term positioning on this one also. I went out to the September 12th weekly options and bought basically the at-the-money 305 strike call. And then in the near-term September 5th weekly options that expire in just 1 day, we're going to sell the 320 strike call. So a bullish $15 wide call diagonal. You're going to pay roughly about, I've got an $8.60 debit, I believe, on this one. It's trading closer to $8 right now because the stock has pulled back. But the debit you pay is going to be your risk on this trade. So if you pay $8.60, you got $860 in risk. But you can see here from the risk profile, anything above about 307 is going to be profitability with the apex of that profit graph that we've got on there is at or near the 320 strike. The 320 strike sets up with about that one standard deviation move to the upside that the option market's kind of pricing in, that plus or minus $18 move. So this takes advantage of, as I mentioned, that vol dispersion where out in the September 12th weekly options where I'm buying the at-the-money 305 strike call, you're buying about a 64% implied volatility on aggregate in that option series. And then in the near term, September 5th, weekly options, where I'm selling the 320 strike call, you're selling about 130% implied volatility. So it's a lot higher, which reduces. This is a $15 wide bullish call diagonal that I'm only paying roughly about $8 for. So that dispersion lowers the entry price and the risk on this. The key is you do need that move higher. You're aiming for 320, but at the same time, anything above a 307 is going to be profitability on this one.
All right, great stuff. Tom White, thanks so much for getting us across your example trades for Broadcom ahead of those earnings.